definitely a revolutionary technology. At the same time, a bit scary. But who was this? I think it was, I forget his name, the founder of Microsoft.
Oh, Bill Gates?
Bill Gates, there you go, his name. Bill Gates, even he said that if you don't have the amount of money, such as what Elon has, you shouldn't be investing on it. And I found that interesting because Bitcoin is getting that expensive, and if you were not, willing to lose that amount of money on just one asset, then you shouldn't be investing on it because it's very risky as well. The return might be good, but it's risky as well. Like we just saw going from from 30K to almost 60K, and now it's sitting on 47K. And it's just a matter of days. This is a conversation between friends.
None of what is said here should be taken as legal advice.
We are not experts in any way.
Take what resonates and leave the rest.
Welcome back, everybody. This is Shots of Info once again. For today, we will be talking about the markets and this unexpected, actually not really unexpected, downtrend that we have seen on the previous 5 days, almost 5 days actually. Wait, why do you think is the reason for this downtrend? Or what are some of the reasons for this?
Right. So yeah, this kind of plays into like a lot of things, and we'll try to keep it a little bit more interesting. That way, those people that aren't particularly interested in the finance section that we used to do, are interested. But generally speaking, basically, we've been in this weird situation with the pandemic where, for some reason, the stock market has gone up while everything has been closed down, right? So there's this disconnect with reality from the markets. And one of the biggest benefactors from this disconnect has been technology companies. So I think your big technology companies, right? Google, Apple, Microsoft, Tesla, all those guys. So these guys have just been getting unproportionately huge relative to like the whole state of the world at this point. And simultaneously, we've been having a lot of money being printed into the economy and not much in the form of it being spent. It's kind of just like it's going out and it's just either being pocketed or something is happening that we're not seeing with that money. Or like with with Trump and the previous stimulus that he did, it was going towards foreign aid, a lot of that money, right? Which wasn't being seen by Americans. In any case, what happened was basically just a consequence of having way too much money out in circulation and not having it be spent in any meaningful way. Because again, during this whole pandemic, businesses have closed. The only thing that's really been open during that time during the quarantine where everybody was like in their house were, big stores, right? You got your Target, you got your Walmarts, you got your pharmaceutical companies, and things like that. But like the little stores, little mom and pop shops, all these things stayed closed and they either went bankrupt or they found some way to survive, but it's not really doing too well. So yeah, that's where we're a good starting point. What about you? What do you think?
Right. So from what I have seen on the news or just heard, it's mainly due to like what's it called, the Federal Reserve Bank. It had to announce whether it's going to keep the yield low, the interest low, or it will increase. Now there's a lot of fear about inflation on the money as well, because it's been, like you mentioned, it has been printing throughout this time, like more and more money to the economy. But we not like the thing is that the money is not getting distributed as it should be, like throughout the economy. Rather than doing that, it's just being accommodated on certain sectors, such as in tech, as what we have seen so far, and the wealthier getting wealthier, and the average class and middle class and poor class, it's getting poorer, like they're losing money due to the pandemic. So this is what we call a K-shaped recovery, and there has been talk a lot about this throughout last year, right? About how the markets are recuperating. It's not a normal recovery, because some sectors are getting more money and some others are not. So the issue about the interest and the inflation is that a lot of traders, a lot of investors, they know, or they fear that the market are going to crash, as we have seen it throughout this 5 days period, that it will not be sustainable eventually for these big tech companies, especially, or like these industries, that emerging industries, or these meme stocks that have been happening throughout this time, which are kind of like surprisingly that, you know how even Warren Buffett said that the stock market is not longer, like, it's unpredictable. Like, he doesn't know what it's doing, because it's doing its own thing, and it's a lot thanks to, well, not thanks to, but like, it's a lot of the a consequence of retail trading that we have seen this previous year. Actually, during the pandemic, picked up more and more in apps such as Robinhood, Stash, or other companies have made this possible, made this available for the average Joe to trade in the markets and kind of be the competition for big hedge funds, even though hedge funds is managing millions, if not billions of dollars in the market. But even though a lot of retail, it's definitely going to make a huge heavy load. So a lot of these retailers now, they don't think the market is going to keep going up. So they think that now that a vaccine is rolling out, that there has been news about the economy and everything opening on July, as early as July, it's earlier than predicted, and so on forth. People are now looking into safe havens, or safe stocks, safe companies such as ETFs, industry that can recuperate during post-pandemic, and so on forth. So they're shifting the money from that industry up on big tech mainly into different sectors now. And that's why we have seen the rise. I think, hold on, if I'm looking at the heat map right now for today, we have seen that the market overall recuperated, bounced back some of it, but a lot of the services and basic materials, they were on green throughout these days, and oil, I think, as well. But it's looking a little bit more greener, but technology and healthcare is still on red, like super red, which is kind of crazy.
Yeah. So like one of the things is, especially with this drop within the last couple of days, like a lot of it is being led by tech, because tech has grown unproportionately throughout the pandemic. But some things that have been actually coming up pretty nicely are the things that kind of took a big hit during the pandemic. So things like airlines, hotels, cruise lines. We were talking, well, I mean, you and me were talking about it. AMC. AMC's movie theater, and that's in New York, that's being reopened now with 25% capacity. So that's actually been going up, and it's not necessarily just the meme stock anymore that's going to be, driven up like crazy in price. I mean, it can happen for sure, because I think now like so many people hold AMC, just like they have it in their accounts. So that's one thing that could happen, like another squeeze that sends it up to like $50 a share or something like that. But on a more fundamental side, it's coming up for good reason. Everything's starting to stabilize and get back to normal. And, I enjoy going to the movies, and I imagine a lot of people do. So as the movie theaters open back up, that's going to start increasing in price. So that's good. Let's see. Anything?
Another consequence also, I think, for this unprecedented or kind of unpredictable market is Bitcoin. I think it had some role in how people looking at investment nowadays. Like, it's not really on the long run, but they trying to get rich quick scheme type of thing. So I feel like investing on Bitcoin, like, in my opinion, it has a lot of potential, because it's a new technology, and blockchain is definitely a revolutionary technology. At the same time, a bit scary. But who was this? I think it was, I forget his name, the founder of Microsoft.
Oh, Bill Gates.
Bill Gates. There you go. His name. Bill Gates. Even he said that if you don't have the amount of money, such as what Elon has, you shouldn't be investing on it. And I found that interesting, because Bitcoin is getting that expensive, and if you were not willing to lose that amount of money on just one asset, then you shouldn't be investing on it, because it's very risky as well. The return might be good, but it's risky as well. Like we just saw going from from 30K to almost 60K, and now it's sitting on 47K. And it's just a matter of days, and Bitcoin trades daily. I mean, 24 hours. So
Yeah.
have a lot of downsides, I guess, in my opinion.
Yeah, and like again, Bitcoin is a part of technology companies. Well, it's not really a technology company; it's just a technology currency, right?
Right.
So yeah, that's just going to follow suit. But one of the things that ended up happening today was that there was this meeting or this so what's it called? Presentation? I don't know. But the Federal Reserve, the leader Jerome Powell, he gave a speech saying that they're not planning on raising interest rates, and that's one of the other things that caused a mass sell-off. When the interest rates go higher, that means inflation is going to start kicking up, and people are starting to do mass panic selling in order to to save their money. And then another thing is that rather than spending the money and putting it in the market to stimulate the economy, what people do is that they save it because there's a high interest rate on your savings account moving if they decide to raise the interest rates. But if they're keeping the interest rates low, then they're trying to stimulate people to spend their money, especially now that we're supposed to get this stimulus coming up soon. So people, the government wants you to spend your money. That way everything keeps moving, because otherwise that's where we end up getting a market crash. At this point with the way we are in the pandemic, we're right on the edge of maybe coming out of it. And, the market crashes, that could kind of just bring everything right back down to square one. So you want to be careful about not doing that.
Right. Yeah. I think there's, the people in the Federal Reserve, they have to be very particular and very kind of analyze, look into what have happened before and how people are going to react to this news. Now, I'm not sure if, the stimulus passed already? I think.
No, it's in the process of being passed.
The process. Yeah, but, another kind of injection of this sort of amount of money in the economy can be good on the short term, but in the long term, I'm looking some of the side effects. Your dollar is not going to be worth from a year from now. It's not going to be the same worth as it is now. So it's a very risky thing to do as well, especially on this economy, which is very, very uncertain. But
more and more money gets putting out there, and the more volatility that gets put into the market.
Right. No, but I think overall, for example, I was diversifying my portfolio, and I have faith on my long term, man. That's why I didn't I was listening some cash, and I was I'm not selling it, because even when you're selling it, you gotta file taxes. And I was let me just hold it for the long run. Let's see how this turns out. Technology is a huge part of my portfolio, because tech, is everything right now. It makes up more than, actually now it's down to 30%, but still, it's a huge chunk. So we'll see how it reacts. And we already saw that, in the last hour of the trading of today, it was slowly picking itself up, because you mentioned that they're not gonna rise the interest rate. Everybody, kind of breathe. So we're probably gonna see some uptrend tomorrow. That's where my guess for tomorrow.
So let's speak to one other thing here. Okay, so everything's following the market. Well, more specifically within the tech sector. And if you're somebody that was heavily invested in tech, then you took a big hit. Today, I took a pretty decent hit. I think I was down 10% total.
Right.
Of a pretty big portfolio or a decent sized account. So it's bouncing back now, which is good. But that speaks to two things, right? You need to be diverse, and you need to watch your positions, right? Because a lot of this, for the most part, a lot of these companies, especially these technology companies, they went on discount. Now you can start buying, rather than buying one share of Tesla at almost $900, now you could have bought it as low as $600. Maybe you could have averaged that up and bought 2 shares, right? As opposed to the 1 share at $900. So now you have more stuff to play with. So if you were good about not having too much money invested into the market, and then too much money invested into one sector or one section in the market, this is where you can really start utilizing, good strategies and really start making decent money or a good amount of money once everything starts recovering, right? Because the only way everything completely falls apart is if the economy completely shuts down. And by that point, money doesn't really have any value anymore, because the value that we give money is literally what you and me say that it has, or what the government says that it has. But at that point, there will be no government, so it won't matter. So to play the money game. Go ahead.
Just to piggyback from what you just said before I forget, the aspect that it went down, that you should definitely see opportunity here. I definitely increased some of my positions in certain companies that went really, really low. Now in Tesla, because Tesla, it's always unpredictable, so I'm gonna just stick with the amount of shares I have now. But other companies that I was looking on was solar. What else I added today? Oh, Pelotor, PLTR.
Palantir.
Yeah, Pelletier. I increased my position on Jumia, also on the fund ARC, and some of my trades for the day, just sharing it, and PBW. So those some of the positions that I took. And now some of these industries are diversified in the sense that they're not all tech. Most of them actually not tech, like e-commerce, something that's emerging markets as well, something new. And that's really where you get to see like the most growth, I would say, overall. So definitely take advantage. Looking at your portfolio during this time probably is a good thing. Not to sell it, but if you have an extra cash laying around there, definitely put it and buy some extra shares of those companies that you can afford to. Another thing too, I think the plan that you sent me, remember, that your new portfolio with the 20%, I think it was at 20%, just on the side. I think that's a very, very smart idea to just have for opportunities like this to, you just buy in and looking next in a year or 2 years, those are going to give you really good results, really good returns. I mean, so that's very smart to do that.
So just to clarify, so like the way I create, I mean, as I've been trading and understanding how to go about being a better trader and investor in total, one of the things that you end up finding is that the more money you have available to play with, the more you can take advantages of opportunities. Because that's one of the things you really want to be doing. You want to be looking for the best possible deals in order to take advantage of, because that's where you're going to make most of your money. Because on the bounce back, that's where you're going to see a lot of return. And if you load it up somewhere near the bottom point of wherever the fall was, and it goes all the way back to where it was previously, boom, that's a decent chunk of change right there.
Absolutely.
So you always want to be working with trying to have, I would say, anywhere from like 20 to 40% of your available cash, like whatever you're planning on trading or investing with, have that on the side, 20 to 40% for moments like this, where everything kind of just completely just goes to shit. Now you can actually buy in a little bit more, be a little bit more aggressive with that money. And, if it keeps dropping, then you can either wait it out, see where that bottom is going to be, or you can just slowly keep adding in more into the position until eventually it pops back up.
Right. And actually one of the, going back to Microsoft, one of the really good opportunities that I saw is Microsoft, because they're really coming up. Their little puppy, LinkedIn, they came up with this new feature. It's kind of like Uber, but it's for job. So like with your LinkedIn page, you can actually offer your services and be a contractor. Now, they were trying to acquire TikTok back in the past. They tried to acquire Pinterest. Those went south, but now they're putting some interest on Etsy because they're really trying to get into the e-commerce market. So I see Microsoft in like within next year or 2 years, making huge competitions on the e-commerce for Walmart and Amazon. So definitely keep an eye on that one. And it was really cheap today as well to get in. But yes, that's one on other opportunity that I saw. When it comes to EV, there's a lot of players nowadays. Aside of Tesla, we have NIO, we have Pelotor.
No, Palantir isn't a EV stock. So you got things like NIO.
Yes.
Yeah. You got NIO. You got things like XPeng, XPEV, Lee. In the U.S., you have things like Lordstown Motor, ticker RIDE. Yeah, Nikola before, but that was a trash company, so no.
Yeah.
Workhorse. There's a bunch of them. There's this new one coming out now, Lucid Motors, with they're doing a merger with a SPAC company called CCIB, or the ticker is CCIB, right? So these guys they're making like literally direct competition with Tesla, because a lot of the like engineers and a lot of the people from that company, the Lucid Motors company, are coming from Tesla. They were ex-Tesla employees and employees from different EV companies. So, something that's coming up down the pipe that has some future potential. And we're looking to that. But yeah, go ahead.
Absolutely. And there's a lot of opportunities right now that you mentioned those, because it's just good time. It's really good time right now to buy. But my fear, like when I was doing this yesterday, it was like, I don't want to buy it too early. But right now we saw a clear or a solid support for the markets. So we can just see either tomorrow going flat or it start picking itself up on an uptrend. We'll see how it turns out. But my prediction is that it will start going back up, especially the healthcare sector and some of the tech as well. But I'm just looking at the chart right now. I mean, it's just slowly turning green. I'm gonna share my screen so you can see it as well.
Go ahead.
So we can talk about like the breakout here. So take a look. All right. So we see how it's divided into the different industries, right? And we see consumer goods, healthcare, and tech, they took the major hit today. But in the previous hour, we already see how they turning green, like slowly but securely. And we see financials, especially today, I think they were clear winners because of the interest not going up. But yeah, I mean, we can, sooner or later, we might see this all green.
Yep, I would imagine within the next couple of days, we'll get a bounce back. I wouldn't be surprised if this starts pushing more talks to the stimulus coming out a little bit faster as well. True. So, and that would definitely bump everything up.
But, and you were mentioning this about Churchill Capital Hoard.
Yeah.
And let's take a look. This one is actually super down, even regardless about the spec. It actually went down.
Yeah, so one of the things is that, so they got confirmation of the merger because right now that company isn't Lucid. It's supposed to become Lucid soon. So they got confirmation of the merger, but what they did was, I believe it was Lucid, they offered shares to, I don't know, I'm not sure who specifically, just like insiders of the company or whatever. They offered shares for like $15 a share. And that ticker at CCIB was trading at highs of almost $60 when that news came out. So that dropped the price significantly.
Right. Yeah, let's see. Yeah, it did reach, I think this was like probably a month ago.
No. Literally within this last week, it was peaking out.
Oh yeah, wow. Yeah. They took a huge drop. Yeah. I picked these ones on like some YouTube videos that they were like advertising this a lot. I didn't really pay attention because sometimes meme stocks, they just like drag you out, Like in my case, I usually don't tend to pay too much attention to what they do because they pretty much just short trading or day trading. Maybe it's more appealing for you. But for me, usually just look into like the fundamentals.
Yeah. That's usually that's the best way to play it. But yeah, that's a good company that's coming up sooner or later. Again, so the way that one plays, SPACs, special, it's an acquisition company. So like they acquire the rights to become that company once the merger goes through. Special purchase, something, acquisition, something.
Yeah, SPACs. I remember.
In any case,
talk about that in
moving forward,
yeah,
we can cover that in a later day. The last point that I want to go over, and then maybe we can wrap it up, is the fact, so yeah, we talked about having money available on the side for these opportunities, but then the other part is to be diversified, right? So as you showed up in the charts there, right, there was a bunch of different sectors, right? So you had consumer goods, you had technology, you had finance, you had healthcare, etc. So that's a good way to try to, lessen the blow when it comes to things starting to come down, especially with, again, the whole pandemic and the disconnect between the market and reality. So a nice diversified portfolio would definitely lessen the blow. And that's something that you've been working on, right?
Absolutely, yes. When it comes to diversification, actually, I'm not trying to be too diverse now, because sometimes diversifications can also be, like anything, it has its downsides in the terms
Too
that
much of anything is always a problem.
yeah, it can drag your portfolio not to grow as it should have. It should have, you have divided, let's say, into 5 different industries rather than doing 15 industries. The growth for those portfolios are not going to be the same. So I've been trying to definitely look into certain sectors, but now past, I'm setting myself to 5 sectors. So it would come raw materials, well, like materials, because 5G is definitely on the process. Like it's happening, whether we see it or not. So Verizon is one of the huge players on there. We have, what's the other company? Anyways,
Qualcomm?
I think, no, Qualcomm, actually, they're down. I have some shares on Qualcomm, but they made me lose some money. But they're good. But I think
Trying
Verizon.
to take time.
Oh,
Plus, it's a Chinese company.
which one?
Qualcomm.
Oh, Qualcomm, yeah. Oh, Skyworks Solutions. That one
Never
is
heard of it before.
5G, but it's supposed to actually have huge returns. And even Apple is in this kind of as they keep developing new technology, they're coming up with a new design for the MacBooks. They're coming up with they're going to need a lot of these chips, but it's going to be included with like 5G on their phones. So these certain companies, they're going to be beneficiaries. Anyways. And then to build this 5G technology, then we have raw materials, because you actually need the materials such as aluminum, fiber optic, as well as I think it's silver. Either or. But I'm doing
Nickel?
like
Nickel, maybe?
nickel, yes. Maybe it's nickel. But I'm doing an ETF for raw materials. I'm getting on Vale, BALE, for that.
Bale?
So, Bale, yeah. So raw materials, tech, so like, emerging markets such as 5G. Then I have tech overall, like information technology. Then I have some e-commerce, retail, and yeah, that's fine. That's pretty much where I'm like surrounding myself. Definitely wanted to keep looking into some hospitality, but most of these are kind of like ETFs of other different sectors. I'm not like buying individual companies for those sectors. But yeah.
Yeah. So there's something to be said about being overly diversified. That becomes a problem because then it's just being in too many things. You're spread way too wide and nothing can kind of rise. Everything kind of just like stays stagnant. So you definitely want to be looking at, you got growth opportunities in the tech sector because that's always growing, right? And then you can do like subsections within the tech, things like EV, things like 5G development, just consumer goods in terms of like Apple and the phones, or Google and all the services that they have. But yeah, the more diversified you are, the better off you can kind of balance everything. But if you overdo it, then that becomes a problem as well. So it's about finding the balance, and it's all up to you, right? It's all up to what you're actually interested in, getting into. Because maybe we're big on tech, but maybe you're somebody that kind of has a really good understanding of the hospitality industry, right? When it comes to things like airlines or cruise lines, hotels, whatever, and that's something that you want to focus on. Perfect. That's your niche. And when it comes to niches, the better you become at one single thing or a couple things, the better you're going to be at just looking for the value, finding the value, and profiting from that value. So there's definitely something to be said about that.
Was another thing too. So let's say you see how like on one Amazon share, it's you don't have this problem because you buy usually partials. But I like my shares fully. So on Amazon share, it's 3K, about 3K. So that it's actually about like 11% of my portfolio. according to my Robinhood account. So one share makes 3% of my portfolio. So you also have to want to keep in mind this. For example, with just 3K, you can buy multiple, or like, let's say like 100 shares of Bale, because Bale is like sitting on 20, so in the range 20 to 30. So the number of shares that you have in each industry doesn't really matter, doesn't equivalent to the amount of money that you're putting into the sector. Because this, if you get like 100 shares of, I don't know, Verizon, it won't be the same as having 100 shares of Amazon, because the money difference is going to be huge and the percentage is going to change. So I would say moving forward, this is what I have been learning, is that when it comes to money, when it comes to portfolio, don't really look at the dollar sign, look at the percentage sign. And that's something that I have noticing more and more, and it's more efficient that way as well. But yeah.
That's why I really like fractional shares, right? Because I can work with the percentages as opposed to me needing to have a certain amount of capital to buy the companies or the shares. Because that way I can, actively work on having a strong portfolio without needing to have so much money.
Yeah, no, that definitely works. I don't know. I'm just like my things as a whole.
No, I get it. You like it even. You like it round.
Yeah, true. But anyways, that's pretty much it for me. Economy is not booming, but it's getting there. Pandemic sooner or later is gonna get over, and people are starting to think ahead. That's why they're panicking on the things that might not work out, and shifting their money to industries that might recuperate. And well, that's how it is. We're on unpredictable times.
Yeah. And that's the market in general. The market is unpredictable. So don't think like, oh man, if I'm losing money, it's because, I'm not good and I should just not do this because I suck and I don't want to keep losing money. Listen, man, we talked about it in the past. This stuff is cyclical. I don't know if it'll happen within the next week. There's a good chance that everything bounces back within a week or so, or two, just because the cycles of how fast things recover is getting pretty insane. But I don't know if it happens in a week. I don't know if it happens in a month. I don't know if it happens 6 months, a year, whatever. Most of the times, 90% of the times, it'll bounce back. So don't beat yourself up. Again, it's just about having those good strategies.
Yeah, and also don't beat yourself up if you are losing gains. So if you already made profit, let's say you already made 10 grand in solid profit, don't cry if you lose 1,000 of those profits, because technically you're not losing. And just think about it like a reinvestment, because you're like building it from there. Like just look at it as a sell opportunity, like a sell opportunity in a sense that you can buy more and you can increase your position a little bit more on certain companies. So yeah, no. With me,
I think today at my worst, I lost 5K.
That's not bad. Boy, from your capital or from like profits?
From my profits.
From your profit. It's
almost slightly dipped into my capital.
Capital? Oh no. Yeah, I'm actually grateful I never lost from my capital. Like I think like maybe on my first day I lost some cash, but no, other than that, that's
you live, man. You live and you learn. That's it.
Yeah, that's
I promise you will make all your money back if you just leave it there. So long as you understand that you're investing in value companies and not just, pump and dumps or penny stocks. You have no idea what you're investing in. You're just like somebody told you that this is going to run and it's a really low price. And that's usually the 10% where it doesn't bounce back.
Yeah, you know that too. Like we mentioned about separating your accounts. One account for day trading with the money that you can lose, that you are willing to lose. Because those are the trades that they're going to south. And another account with the money that you truly, want to more like saving and let it grow with time. And that's pretty much it. Be patient. Patience, my guys. All right. With that, we wrap it up and we say goodbye.
Peace.
Peace out.
What the is we doing?